Which preferred stocks do you currently hold? What was your job before you retired? Are office REITs a good deal right now? And how do you know when to sell? I'll answer these and other questions in today's Q&A. Hi from Vietnam. I tried this Q&A format last month and it was a hit, so we're back for round 2. Question number 1, which preferred stocks do you currently hold? Well, I've got 4. PFFA, which is currently yielding 9.69%, that's a fund. AGNCN is yielding 10.55%. NLYF is paying 10.29%, and VIA-SP yields 15.31%. I made a video covering the basics of preferred stocks, and since then the only reference I've made to them is PFFA, which is the ETF, and that holds a basket of almost 200 preferred stocks. That fund is one of my 10 largest holdings, as explained in this recent video, because it offers so much diversification within that asset class. The investments in the 3 individual preferred stocks are smaller, especially VIA-SP. That's less than 1% of my portfolio because that one is pretty risky. Preferred stocks offer less upside than regular stocks, but more predictable income. They're also quite complicated to analyze. If you want to do a really deep dive into that, well, what becomes a rabbit hole, then the best resources I've found are Systematic Income Investing and the REIT Forum, and I'll put links to those in the description. But for most investors, it's easier to get exposure through a fund like PFFA. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in far greater depth, because now they pay for everything, including this buncha, which I can smell right now, and I'm dying to eat. As soon as I stop recording this, I'll be diving into that. All right, I mostly focus on stocks and funds paying consistent yields of around 8 to 12%. Question 2 asks what I did before retiring. It's a fair question because step 1 of investing is get money, and I'm always curious to know exactly how people did that. So here's the quick version. I was born in Australia, and after university, I wanted to see the world before settling into a career in real estate. So I worked on cruise ships, mostly Carnival, Royal Caribbean, and Celebrity. Eventually, I worked my way up to a management position in Miami, and the company I worked for sponsored me for a green card. So that opened up a new option, which was to pursue my real estate career in the US instead of in Australia. So I did that. I specialized in office leasing and office sales, working on 100% commission. And the first couple of years, I made, well, pretty much no money because I didn't have any market knowledge or relationships, and that's really what you're getting paid for. But if you stick with it, after a few years that changes, and eventually the commission checks are worth the wait. In my free time, I bought old houses and apartments with 20% down mortgages. I renovated them, made them really nice, and then rented them out. And meanwhile, both of my parents passed away at relatively young ages due to health issues, which made me rethink a lot about life. We only get one turn on this crazy ride, and we're not guaranteed to make it to the end. So I decided to retire in Southeast Asia in my 40s. With the lower cost of living, you can retire younger here, and it was frankly the best decision I've ever made. I sold my real estate, sold my growth stocks, sold my growth funds, and switched to income investing, which has become a major passion, hence this channel. Question number 3, are office REITs a good deal? Everybody knows that the office market has suffered since the pandemic, especially markets like San Francisco. Remote working plus higher interest rates equals a lot of stress for landlords. Therefore, some office REITs are offering high yields. One of the examples this person asks about, ACRE, currently yields over 14%. And until June 2023, their dividends showed a nice pattern of growth. Despite the high yields, I'm avoiding office REITs for 2 major reasons. Firstly, the scale of the current risks is unknown, especially high interest rates. The longer they remain high, the greater the risk of defaults as more loans mature and need to be refinanced at high rates. Secondly, after working in the office market, I'm just not a fan of investing in it, regardless of the economic cycle. The margins aren't great because of the cost of re-tenanting. Every time a new tenant signs a lease, there's money to be spent on construction. Now that could be $5 to $10 a foot if you're lucky, but often it's $10 to $50 a square foot or more if walls need to be moved. The landlord typically pays a large chunk of that. I prefer multifamily and industrial, where the cost of changing tenants is much less. Also, the demand for those assets will never go away. There will always be a need for low-cost housing, and there will always be a need to store inventory before distributing products to customers. Unfortunately, that's common knowledge, so those REITs are really popular and pay a low yield, which is why I don't feature them on this channel. That's a fairly high-level answer. If you want a proper analysis, Trapping Value is one of my favorite authors on Seeking Alpha, and they break down exactly why they think a distribution cut is likely for ACRE. I don't buy a stock or a fund without first checking at least 2 or 3 analysis articles on Seeking Alpha. I'll link to that article and a discount for premium membership in the description. Question 4 is a quickie. Do you offer paid advice? No, I'm not a financial advisor. Even if my friends ask me about investing, I'd only give them general feedback on the pros and cons of an investment. I wouldn't tell them what to buy or sell. Aside from the regulatory qualifications, I think financial advice is a huge responsibility and a full-time job, and I don't want either of those things. Question 5, how can you find a good financial advisor? Well, this one's difficult. Plenty of advisors will put you in a mix of safe index funds and funds that pay them a commission on the back end, on top of the 1% they charge you. The incentives aren't really in your favor, but some of them are good and will help you avoid stupid mistakes like panicking when the market crashes. There's no easy way to find the best financial advisors. My only tip is to ask your tax accountant who they recommend. Assuming you have a really good tax accountant, which I suggest because they're worth every penny, they'll know exactly who's making the best returns on their investments because they see all the confidential numbers when they're preparing tax returns. A good accountant will also be able to refer you to a good mortgage broker, realtor, a good insurance agent, etc. Their network can be quite valuable, even more valuable than their ability to figure out how to claim that trip to Hawaii as a deduction. I used a financial advisor when I was busy working, but I don't use one now. The final question for today is, how do you know when to sell? Well, first of all, I don't sell to pay for living expenses. That's part of the reason I'm an income investor. Trying to time selling when the market is up would cause me a lot of stress. Ideally, I don't want to actually do much selling. I'm more of a collector of income investments. However, sometimes selling is necessary, so here are 3 scenarios that lead me to sell. The first one is if the yield falls too low. Ideally, that would happen because the price went up much faster than the distributions did. An example of this is OKE. Contrarian Income Report advised to buy it during the pandemic when it was yielding about 14%, and I took that advice. The dividends increased, but the price increased much more, and so once the yield fell below 7%, I sold it back in 2021. Now, in hindsight, I would have made a much higher return if I hung on to it longer, but I'm not a growth investor. I was in it for the income. This yield history chart is a handy way to compare the current yield to its historical average, and it came from Snowball, which I use primarily to keep track of my investment income. If you want more sophisticated dividend information than your broker's website will give you, Snowball is quite affordable, and you can make it even more so if you use the link in the description because there's an exclusive discount for Armchair Income viewers. The second reason I'd sell is if there's a fundamental change that invalidates the reason I bought the investment in the first place. For example, a few years ago I bought MPW because their history going back to 2005 indicated that they were good at owning and operating hospitals. They had a great reputation. Then one of their major tenants, Stewart Healthcare, fell behind on their rent, and this uncovered some aspects of the relationship between the two companies. Firstly, this one tenant represented a significant chunk of MPW's revenue. Secondly, instead of letting them default, MPW gave Stewart a series of sweetheart deals. That's a red flag, and to me it signals that they couldn't afford to lose that tenant. Stewart is a private company, so I couldn't really look at the true nature of their financial health. After reading about the Stewart drama, it became clear that MPW's business model wasn't as rock solid as I'd first thought. So I sold MPW at the beginning of what ended up becoming a really long, steady decline. In the OKE example, I sold when the yield was too low, and in the MPW example, I sold because I didn't like the business anymore, even though the yield was really high. The third reason I sell is if the price goes up so much that the position becomes too large in my portfolio. This happened recently with some BDCs like Capital Southwest and Hercules Capital. They shot up in price, the yield was still attractive, but I didn't want to be overweight in BDCs, so I trimmed them back. I didn't sell all of them. I also wanted to weigh more to the PBDC fund and less to individual BDCs. This third reason doesn't happen very often because income investments usually deliver most of their returns via distributions, not price appreciation. So Capital Southwest going up almost 50% in the past 12 months and paying out a yield of more than 8%, that's not normal. I don't have any rules for selling based purely on price. Prices bob up and down with the market and the economy, and I mostly ignore it because I'm not a trader. That's 6 questions covered. I'll get back to specific income stocks and funds in the next video. You can find reviews of my top 10 favorite income investments in this playlist here. More Armchair Income coming soon. All right, I am starving. Start with the spring rolls.